Hello. Yeah. So, welcome to this session, and typically let's start with this new subject, not new subject, new chapter from the paper. So, we are together for the session series on ICWA final paper 20A, that is Strategic Performance Management and Business Valuations, in short called as Spm&Bv. And myself, CACS Pushkaraj Vishnu Joshi, and we have been together for this entire syllabus, and we are currently undergoing module 8, and in that, which has a weightage of 15% in the overall scheme of marks as given by the institute. And in that, in this module there are almost, so the name of the module is Valuation of Assets and Liabilities. Typically the module is designed in such a way that each and every asset, how it has to be valued, what sort of approaches, what sort of methods have to be covered are explicitly mentioned. So different types of asset have to be valued in a different fashion and cannot be one straight-jacketed method or approach that can be adopted for a particular group of assets, and accordingly the module has been devised. So there are almost 8 chapters. In a separate session I have already covered with valuation of plant and machinery, and as you know, the entire session series is based on the study material that has been provided by the institute, and it's a very good detailed study material. And in a way, in this session my presentation will be covering the study material concepts only, and I have personally in a way concised it, summarized it in a simple version so as to fit in within the shorter time frame that has been allotted to me to take the session, which is like within 2 hours kind of a thing. I have to complete the chapter, and hence the entire theory I am taking up in the sessions that I am covering up over here. And for today's session we will be looking at how valuation of inventory is to be done. Again, just to make a mention, the entire module has been broken into various chapters asset wise, and hence each chapter is of a shorter or session, and therefore the session is of a shorter duration, because the chapter itself is very small or less in terms of content, and therefore maybe the sessions would be less than 2 hours or the allotted 2 hours also, because there is no what you can say text per se in the study material that is available. And in a way I have summed up the entire chapter in the slides that I am going to present it in this session. So let's begin with the syllabus, valuation of inventory. So in the study material, typically the concept of and the inventory importance and valuation principle has been mentioned. So inventory is one of the top current assets in a business. Obviously inventory is very important asset, and as you know, or as accountant you know, that it forms a major part of the working capital also, and sits in the current assets, because every small piece of inventory is the money blocked or the funds that are blocked in that particular stock item. So inventory is one of the top current assets in a business, and of course as per the accounting principles and valuation principles, such inventory has to be valued at the lower of cost and net realizable value. So either of whether the cost or net realizable value, whichever is lower, at that value, at that amount it is to be valued, the inventory is to be valued. So that's the valuation principle that is being followed all across. So the 2 key aspects of inventory valuation always are determining the cost of purchase, because if it is a cost or net realizable value, whichever is lower, then the determination of the cost of purchased or manufactured inventory is very critical aspect of inventory valuation. And secondly, retaining such cost in inventory accounts until the product is sold is also, because there at times there may be some kind of a obsolescence that may be faced by the inventory which is lying in the godown or stores as such, and therefore retaining such cost in inventory accounts until the product is sold is also critical. So these are the 2 aspects of inventory valuation. Then let's get into the components of inventory cost. So what are the components, how inventory costing can be done? Typically the components are the cost of purchase, of course. If it is a uh, inventory item which has been purchased, then the cost of purchase is a key component, which includes purchase price including the government levies or government duties or taxes which are levied on it. So in short, GST, import duties and related expenses for imported goods. So if at all that particular inventory item is imported, then the import duties will be loaded onto the cost of purchase, and also the related expenses that would have to be incurred for importing such inventory items or goods will have to be included in the cost of purchases. Third item that is to be included is the logistic cost, because from the import from the a particular point in time, a point of location, the inventory item will have to be carried away or brought to the location where our business is situated, and therefore logistics cost will be also included, which includes warehousing, stock keeping, stores, etc. So again, that is the cost element to be included in the cost of purchases. And fourth item typically which is forming part of cost of purchases is handling cost, directly tied to acquiring goods. So basically the loading and unloading also of the goods which have to be done after the transportation or carriage inward has been done of that particular inventory item. So all these components, right from the point of location from where the goods are being bought till the point of location where the goods are required to be stored, from wherein there it will be sold thereafter, all the cost that is involved or the cost that is incurred is to be added to the purchase cost or the cost of purchases. So in short, the components of inventory cost, the first major component is the cost of purchase, which includes purchase price with government levies, import duties and related expenses for imported goods if at all the goods are imported, logistic cost, which includes warehousing, local transportation, stock keeping, etc. And fourth item is the handling cost, that is loading, unloading, forwarding, etc. one has to do, which are directly tied to acquiring goods. Then comes the cost of conversion. So if at all that particular raw material is there which is being procured, that needs to be converted into a finished good, then the cost of conversion is to be considered. Now this cost of conversion includes direct costs like direct labor, variable and fixed manufacturing overheads. Fixed overheads stay constant regardless of the output. Variable overheads vary with production volume, allocation based on normal capacity or actual production. So cost of conversion, obviously I don't have to you being management accountant and cost accountants who are listening to these videos or this session typically are fully aware of the process costing, project costing, etc. And hence cost of conversion includes all these components, direct costs like direct labor, variable and fixed manufacturing overheads. Fixed overheads stay constant regardless of the output, and variable overheads vary with the production volume, allocation based on normal capacity or actual production. So these are the components of cost of conversion cost. So purchase cost is a major component of inventory cost, and secondly the conversion cost. Third item is the other cost. So other cost includes cost to bring inventory to its present location and condition. Example, design cost for customer orders, interim logistics costs, etc. So these are allied costs which are incurred so as to make the product or make the inventory available at the present location and condition also. So the costs that are excluded, so these are the components or these are the costs which are included in the inventory cost: purchase cost, conversion cost and other cost. There are certain costs which are to be excluded from inventory valuation. Now those are abnormal wastage of materials, labor and other production costs have to be excluded from inventory valuation. Secondly, the storage cost, unless essential to production, has to be excluded. Administrative overheads not related to inventory condition or location has to be excluded. Just a second. So administrative overheads not related to inventory condition or location also has to be excluded. Selling and distribution costs, obviously they don't form part of the, because it's a post production kind of a activity, and hence the inventory cost doesn't include, or inventory valuation will not include selling and distribution costs per se. So this is how it's a short chapter, 2-pager, 3-pager chapter, and thereafter, as my method of conducting the session has been, I have taken up short question and answer after the chapter which is there in the study material, and also the long short question and answer. Typically I am covering in those short question and answer what are the concepts that are being discussed or asked and answered also. That in a way I have tried to summarize out over here, which can act as a study points for you in for the students to write in the examinations as such. So short question and answer one, the concept that is dealt is the cost of purchase. What are the components and examples? So in a way the answer includes purchase price, government levies, import duties, logistics, warehousing, handling charges. Example, a company importing parts adds overseas purchases, overseas purchase costs, duties, shipping costs and handling cost also. So this is how the short question answer number 1 has been discussed. Question number 2, costs of conversion and overhead allocation. It discusses cost of conversion and overhead allocation. In that, typically the cost of conversion and overhead allocation includes direct labor and manufacturing overheads, which are fixed and variable. Allocation is based on the normal capacity or ratio of production versus stock. So this is how cost of conversion and overhead allocation is dealt with in question and answer 2. In short question and answer number 3, the concept that is being discussed is other cost in inventory valuation. So typically the other costs are costs for bringing inventory to current condition or location. Example, customized design expenses might be required to be incurred for that inventory, or transport to interim logistics point also. So let's say from A point to B point, the customer wants the inventory to be sent to B point, then that in transportation cost will be included and as other cost in the inventory valuation. In short question and answer number 4, excluded cost in inventory valuation. So which are the costs that are excluded in the inventory valuation are discussed, and especially the abnormal wastage in material and overheads and labor also are to be excluded. Unnecessary storage cost is to be excluded. Non-contributing admin overheads and selling and distribution costs are to be excluded in inventory valuation. In short question and answer number 5, the training cost inclusion is discussed. Obviously training cost is not to be included because it is considered as an administrative overhead, and therefore it is not directly linked to inventory valuation as such, and hence it has to be categorically excluded. It's a admin cost and nothing to do with inventory cost as such, and hence it cannot be included. The training cost cannot be included. 6th item is about normal capacity. In that, definition and use has been discussed. A normal capacity is the average production over time and the basis for allocating, and it becomes, this normal capacity becomes the basis for allocating overhead to production cost. In short question and answer number 7, third party storage cost has been discussed, which typically is not included in cost of purchase or the other costs, and therefore excluded unless essential for production. So then only the third party storage cost is to be included in inventory valuation. In short question and answer number 8, the concept that is being discussed is when cost is greater than net realizable value. The situation may arise, it occurs in market downturns, obsolescence or oversupply situations also. So at times the cost is more than the net realizable value, and net realizable value is less than the cost at times because of the market downturns or obsolescence in the inventory itself, or oversupply situations are there, lot of inventory is available, lot of stock is available. In such scenario, the cost becomes the net realizable value may become lower than the cost also. Then in this chapter, at the end of the chapter, there is, after short question and answer, there is a long question and answers which are discussed. In long question and answer number 1, the classification on inventory cost has been discussed. So the classification of inventory cost can be categorized as cost of purchases, which includes purchase price, duties, levies, logistics, handling charges, etc. Second is the cost of conversion, which includes direct labor, fixed variable overheads. And third classification could be other cost, which includes design for custom needs, interim logistics cost. In long question and answer number 2, when costs are retained in inventory, that is being discussed. Until the product is sold, the cost is to be included in the inventory. It includes purchase, conversion and relevant other cost. So till the point in time the inventory is not sold, all those costs are to be included in the inventory valuation. Third concept that is discussed in the long question and answer number 3 is calculating costs of conversion, custom furniture example wise. So in that it includes direct labor and overheads, utilities, rent. So that's the cost of conversion, and allocate based on normal capacity or actual manufacturing versus stock levels. So that's how the calculation of cost of conversion is done. In long question and answer number 4, inventory valuation for supermarket chain has been discussed. So what sort of valuation should be adopted by a supermarket chain? So FIFO, that is first in first out, is most suitable because it aligns with perishables being sold first, reducing spoilage. So that's a wiser thing, and that's how the valuation should be done of inventory for supermarket chain. The perishable items should be sold out first immediately so that the spoilage is less, and thereby the inventory valuation can be controlled. So that's how the valuation is done on FIFO basis in supermarkets, in supermarket chain. Then comes a long question and answer, which is number 5, which talks about normal capacity, role in overhead allocation. So what is meant by normal capacity? It is the average production over time that is taken for a particular inventory item. It is used to proportion overhead cost fairly to inventory. So whatever overheads that are being incurred for the production, those overhead production absorbed are required to be fairly loaded onto the inventory. So for that purpose is normal capacity is used for overhead allocation. The sixth concept that is discussed in the long the concept that is discussed in the long question and answer number 6 is the cost specifically excluded from inventory valuation. So which are the types of costs that are specifically excluded from inventory valuation are abnormal wastage, spoilage of material, labor or overheads also for that matter. No essential storage, non-essential storage are costs are excluded. Administrative and selling and distribution costs are excluded. All these exclusions are justified because they don't directly enhance inventory value, and therefore these are excluded from the inventory valuation. So with this, in a way, we end the chapter session also. And just to, as a matter of practice, I have been summarizing the session. So we started off with the section B, module 8.2 chapter, which is about valuation of inventory. And in that we started off with the inventory importance and valuation principles. So inventory is one of the top current assets in a business. It is valued at lower of cost or net realizable value. The two key aspects of inventory valuation includes determining the cost of purchased or manufactured inventory, and second is retaining such cost in inventory accounts until the product is sold. The components of inventory costs are cost of purchase, which includes purchase price including government levies, import duties and related expenses for imported goods, logistics costs like warehousing, storage, storekeeping, stock keeping and related logistics, handling costs directly tied to acquiring of goods. Second is the cost of conversion. Now this cost of conversion is from raw material to finished goods cost, which are typically the direct costs like direct labor, direct costs like direct labor, variable and fixed manufacturing overheads. Fixed overheads stay constant regardless of output. Variable overheads vary with production volume. Allocation based on normal capacity or actual production. Other costs were also discussed, which includes cost to bring inventory to its present location and condition, Examples, design cost for custom orders, interim logistics cost. Cost excluded from then was discussed from inventory valuation. So there are certain costs which are excluded from inventory valuation, which are abnormal wastage of materials, labor and other production over cost also. Storage costs unless essential to production. Third, administrative overheads not related to inventory condition or location has to be excluded. And lastly, selling and distribution cost is also to be necessary excluded. All these exclusions are justifiable because they are not related to inventory at all. That's what the logic is. Then we saw through short question and answer wherein cost of purchase, components and examples were discussed, which includes purchase price, government levies, import duties, logistics, warehousing and handling. Example, a company importing parts adds overseas purchase costs, duties, shipping and handling also. Cost of conversion and overhead allocation includes direct labor and manufacturing overheads, fixed or variable. Allocation is based on normal capacity or ratio of production versus stock. Third concept that is discussed is the other cost in inventory valuation. So cost for bringing inventory to current condition or location. Example, custom design expenses, transport to interim logistics point. Excluded cost in inventory valuation, abnormal wastage, unnecessary storage, non-contributing admin, overhead, selling cost. Training cost inclusions includes not included, considered an administrative overhead not directly linked to inventory value. Normal capacities, definition and use. Average production overtime, basis for allocating overhead to production cost. Third party storage cost not included in cost of purchase, other cost excluded unless essential for production. When cost is more than net realizable value, such situation occurs in market downturns, obsolescence or oversupply situations. In long question and answer, the concepts that were discussed are classification of inventory cost, which are cost of purchase, purchase price, duties, logistics and handling. Cost of conversion, which includes direct labor, fixed variable overheads. Other costs, which includes design for custom needs, interim logistics cost. When costs are retained in inventory until the product is sold, it includes purchase, conversion and relevant other costs. Calculating cost of conversion, custom furniture example, includes direct labor and overheads, utilities, rent, etc. Allocate based on normal capacity or actual manufacturing versus stock level. Inventory valuation and for supermarket, FIFO method is most suitable because it aligns with perishables being sold first, reducing spoilage. Last question, last concept that is discussed is normal capacity. What is the role in overhead allocation? Average, it's basically the average production over time, and it is used to apportion overhead cost fairly on the inventory. The costs specifically excluded from inventory valuation are abnormal wastages, non-essential storage, administrative and selling costs justified because they don't really directly enhance inventory value. So with this, we end the session today, and the chapter of valuation of inventory is in a way completed. So signing off here, CACS Pushkaraj Vishnu Joshi. See you in the next session. And with the new chapter. So I'll end the session out over here. Bye bye. Thank you.